Welcome back. You're still watching Business Morning. Time for the AFEX commodities updates. A lot of the commodities were unchanged for the week 11th of May to 17th. But was this before the release of the inflation figures? We'll get more details now from Michael Martins, portfolio manager at AFEX. Hello, Michael. Great to have you. Good morning.
Hi, Ladi. Good morning. Thank you for having me once again.
Great to have you. Well, so how do you expect the moderation in the inflation rate to affect your exchange?
So some of the dynamics that we see play out in the commodities market is the fact that, and I think we've spoken about this in recent time too, how the fact that most of the commodity prices that we see play out in the commodities market, they sort of act as a leading indicator for what happens in the inflation market, particularly the food inflation. And we've also spoken at length about how there's a very strong correlation, sometimes as high as 80 to 90%, strong correlation between the inflation in the inflation numbers and then the prices that you're seeing for commodities across board. So we believe that if the inflation numbers continue rising sufficiently in the coming months, it's going to serve as an indication of what has already happened in the commodities market, which is ideally what we have predicted for a long period of time, which is to say prices will continue to rise significantly.
All right, so Michael, well, just before we continue with the conversation, could you take us through the movements for the week in your exchange?
Excuse me, I didn't get the question well.
Can you take us through the movement of commodities prices in your exchange for the week?
Oh, yes, sure. Thank you very much for that question. So the total value of transactions traded on the exchange in the week under consideration fell by 79.43%, from around 2.09 billion to around 0.43 billion naira. The total number of contracts traded on the exchange also fell by 83.68%, from around 130,858 contracts to close the trading week at 21,363 contracts. The total number of deals also fell by 70.83%, from around 24 deals to close the trading week at just 7 deals. The AFEX Commodities Index, which is the ACI comprising of maize, soybean, paddy rice, and sorghum, went up slightly by 0.66%, from 383.74 points to close the trading week at 386.27 points. The AFEX Export Index, which contains ginger and cocoa, remained unchanged in the week under consideration at 146.57. With regards to the total volume of contracts traded on the exchange, the total volume of contracts for maize fell from 130,843 contracts to 15,007 contracts in the week under consideration. And soy, we however saw a bit of an appreciation in the total volume of contracts traded for soybean, going up from 15 contracts to around 6,348 contracts in the week. For all other commodities comprising of paddy rice, sorghum, cocoa, ginger, sesame, and cashew, we traded little to no volume across board on the exchange. With regards to price changes on the exchange, the price of soybean went up by 3.21%, which was the top gainer for the week, went up by 3.21%, gaining 982 naira in the contract value to close the trading week at 30,635 naira per contract. And the price of cashew contract also went up by 0.40%, gaining 171 naira in the contract value to close the trading week at 42,818 naira per contract. And lastly, we also have the FETC, which remained unchanged at 14,008 naira per contract. All other commodities under consideration also remained unchanged in the week under consideration. And as always, and as we always say, if you want to know more about the commodities market, you can always go to our website, which is www.afexnigeria.com. And if you want to get started trading commodities, you can download our app on iOS and also on Android. So that's by and large all of what happened on the exchange in the week.
All right, Michael, thanks for that. But there's a phrase making the rounds on social media about in the cryptocurrency market called, buying the dip. Do you see the same phenomenon occurring in the commodities market?
So yes, we do see that same phenomenon occur in the commodities market, and we have alluded to that a lot of times over the course of this show. So what we tend to see in the commodities market is the bullish market starting during and around the period of harvest. That's the month of October and November. And then you sort of see that bullish market run significantly till the month of February, sometimes extending to the month of March. And that's usually also the time period whereby some procurement officers of major buyers of some of these commodities tend to stay away from the commodities market because they've procured a significant portion of the volume that they would need over the course of the entire year. So those are usually the time periods where you would see a dip in the commodities market before prices continue upward. But this particular season, we haven't seen that play out significantly. What we did see this season is a period of continuous sustained consolidation in the market where prices are just ranging between plus or minus 5%. But to truly answer the question, I think it's also important for us to define what a dip is. So some of the financial literature that I have read would suggest that a 10% drop in an asset class from its high would indicate a correction, and then a more than 20% drop in the asset price of an asset would indicate a bear market. Right, but the problem with that sort of analysis is that it doesn't cut across board, and you can't particularly generalize, right? Because a 10% drop in a cryptocurrency market or a fixed income market is not the same as a 10% drop in, say, a commodities market. But I think the more important sentiment would be to say, when people say buy the dip, what they're saying is how do you take advantage of market corrections? And it's a combination of different things, right? When you're doing your analysis, whether or not you're doing it from a technical point of view, whereby you're analyzing price floors or resistant points and anticipating points where price is going to reverse, which would be the dip, or you're evaluating things from a fundamental standpoint and you're trying to evaluate the sentiment of the market or general policies that are coming out. So those are two different things that you can combine and sort of analyze where you need to buy that particular dip, right? But the most important thing would also be market timing, right? Because getting into the market at the wrong time or getting into the market too early is just as bad as being wrong about the direction of the market. So when you want to take a position in the commodities market, for example, and you already have the information that dips are more likely to happen in the month of February and March, then you can accumulate your capital in order to take advantage of that price information and that price knowledge.
Great investment information Michael is giving us this morning. Thank you, Michael. But just before we let you go, now we noticed that a lot of the commodities, your commodities, had their prices unchanged, and we'd like to understand why and the implication of that.
So I mean, so what you see reflected in the prices on the exchange is a pure reflection of activities going on in the market, right? And you'd have to imagine that depending on the commodity that you're considering, the dynamics are different, right? So one thing you would notice is that for certain commodities like grains, particularly for maize and soybean, you'd see a lot of price movement happening depending on the number of activities that you have on that particular commodity in the week under consideration. And that's partly because of, number one, the liquidity that you have for that particular commodity, and then by extension, the volume that you also have in the commodities market. For all other commodities too, it becomes extremely hard for you to replicate those same price dynamics, considering that they don't have the same levels of liquidity, right? The export market is also another one that you could also consider being significantly different from the grains market because, of course, they start their own season slightly earlier, so they also end slightly earlier than all the other commodities on the exchange. So you tend to see long extended periods whereby you don't see any market activity happening with that particular commodity, and by extension, you don't see the prices changing significantly.
All right, Michael. Thank you so much for that update. Do enjoy the rest of your day. All right, so let's talk to Yusuf Ogumbi, now investment manager at AFEX. Hello, Mr. Yusuf. Great to have you.
Good morning. Nice to be here again.
Good morning.
Good morning. Nice to be here again.
So, how has it been getting financing for the supply chain of the agricultural sector, especially at this time when, insecurity remains a huge challenge?
Thank you for that question. Quite intuitive. What I would say is there's been mixed reactions getting financing for the supply side of the supply chain generally. Because of a number of things. Risks, like you mentioned, one of them, the insecurity that we've seen so far, which tends to increase the risk. But then on the flip side, what you then need to do is to structure the product or to structure the financing such that investors are comfortable with what they are getting. So you are balancing the risk-return profile. And you also realize that if you are able to balance that well, investors are quite comfortable with the nature of the product. They will typically come into the market, provide financing, critical financing to provide to support the supply side of the market. And don't forget, the supply side is very, very important. Without it, we'll probably face some serious situations on our hands.
Yeah, so, but what's the impact of that financing the supply chain? What does it have? What impact does it have on the farmers?
Massive impact, massive impact. I'll go from top to bottom. So if you look at, there was a World Bank research some years ago that said that financing the supply side of the agricultural value chain provides 11 times the impact as against investing in some other sectors in the country across sub-Saharan Africa. That's a clear indicator of what impact you might be expecting. If you also look at basic economics, we talked about the factors of production: land, labor, capital, and entrepreneur. A typical supply chain participant has land, they have the labor to provide, and they have the entrepreneurship to also bring onto the table. But on many occasions, they don't have the capital. So if you're able to provide that capital, you complete the equation and you are able to produce comfortably well for the country. So the impact is massive. That's on the production side. For the livelihoods of these supply chain participants, we've observed clearly that if you're able to consistently provide this this financing to these participants, you are able to impact their poverty figures. So take, for instance, some of the, as stated in our impact report, farmers that have been able to work with us, supply chain participants that have been able to work with us for like 2-3 years, they are significantly higher than the poverty line in the country, the national poverty line, which speaks to the importance of the financing that is provided to these farmers, the support that is provided to these supply chain participants. So the impacts are significant, I must say.
All right, tell us about the opportunities for growth in this supply chain.
Significant opportunities, because quite a number of the commodities, quite a number of the products that we consume in Nigeria, we are still in deficit. So you look at the maize that we consume, soybeans, significant for the poultry industry. We still have a deficit in some numbers still tell us that we have a deficit in rice production. And it then tells you that if this staple, we are still in a deficit on this staple side, it means that we need to do more in order to cover. So the room for growth is wide, and we need to do more to cover for that deficit. So that's on the one hand. On the other hand, you have industries also expanding, which means that their demand will continue to grow, the need for these items will continue to grow, which then boils down to the same statement saying that the opportunities are massive, the room for growth is wide, and we just need to continue to do more of the support financing that we have been providing so far.
Well, just before we go briefly now, how has AFEX been able to maximize these opportunities for revenue generation?
Yeah, contrary to what a number of people think, there's actually significant value at the bottom of the pyramid, which is where a lot of these participants operate. So you look at a case where there are market creating innovations are brought about by AFEX. And that means that if you are able to provide services that people need, but then they don't have access to, they are willing to pay a price for it, which then means that you are able to kill two birds with one stone, as the saying goes. So you are able to provide that impact, provide financing, provide support to the supply side. And at the same time, you are also able to earn some revenue from it. And it's sustainable. Basically, that's what we call impact investing. So it's profitable, it's sustainable, and it impacts the lives of these supply chain participants.
All right. Thank you so much, Mr. Yusuf Ogunbi, Investment Manager at AFEX.
Thank you very much.
Thank you for sharing your thoughts with us this morning. We'll just take a moment and we'll be right back.